debt financing and equity financing. Let's look at the words debt and equity at first. Well, debt is actually the amount of money one party owes to another. And equity means the value of shares issued by a company. So clearly we can see that debt and equity are not the same thing. So debt financing and equity financing are going to be very different from one another. Let's talk about debt financing first. This is a straight up loan. You can receive a loan for almost everything, including your business venture. There is going to be a lender and a receiver. The two parties are going to be involved in the financing process. The lender is going to give a certain amount of money to the receiver. And the terms of the loan will also be settled by the lender. The term meaning how much time the receiver has to settle the debt to the lender. After that time has passed, the receiver has to pay back to the lender. And if for some reason the receiver cannot pay the money back to the lender, there is going to be collateral. The lender is also going to decide what the collateral is going to be. If you cannot comply with the terms, the collateral is going to go to the lender after the certain period of time has passed. The lender is going to take away the collateral if they do not receive their expected capital back in a reasonable time frame. The collateral in this case can also be the machines and supplies used in the business venture. So if you cannot pay back the debtor, your business is going to close down. And now let's look at equity financing. Equity is a part of your business ownership. We already know that. In equity financing, there is also going to be two parties. One party is going to give another party a certain sum of money. But in this case, there is not going to be any collateral. In this case, after giving the money, the lender is not going to be lender. They are going to be investor of the company. That is because they are going to give you the money for a part in the company share. When you take that amount of money from these investors as equity financing, you have to provide the company share to them. And after getting the company share, as a result, they can have a say in what you do with your business. And they also have the right to sell off their share of the partnership to someone else if they deem necessary. Now, let's look at the differences between debt financing and equity financing. The differences would be, for debt financing, the company is going to keep the full ownership. But for equity financing, the investors will get partial ownership of the company. And since the lenders do not have any ownership of the company, they do not get to say anything about how you conduct your business. But for equity financing, the investors can direct the way the business will go. So far, I have been talking from the point of view of the business owner. Let's say that you are going to be providing the money to a business owner. You are going to be the lender. Then, debt financing is going to be less risky for you. That is because you are going to have a fixed amount of collateral, and you can get that if the business becomes a failure and cannot provide you with the money they have gotten from you in a specific period of time. If you buy a certain amount of share from a company, it is going to be very much risky for you. That is because there is a very big chance that the company might end up being a failure. If the company fails, the ownership of the company that you have is not going to mean anything. So as a result, you cannot even sell the ownership you have to anyone, and you cannot even get the money back since you do not have any collateral. That is exactly why venture capitalists are so careful before investing in somewhere. Stages of investment funding. The different stages a business goes through and the different ways the business can raise capital for itself in those different stages. During the lifetime of a business, there are various stages that almost all companies have to go through. And the type of investments for each and every single step is not similar. Following are the stages of investment funding for businesses. Keep in mind that these stages are named differently by different people, but the main idea behind when the stage starts and how the company operates at that stage are the same. At first, you have the pre-seed stage. It is also known as the idea stage. In this stage, you do not have anything but the idea for what you are going to do. In this stage, your idea is going to take a tangible form. There are two main ways of financing the business in this stage. The first one is bootstrapping, and the second one is through friends and family. Bootstrapping literally means doing something by yourself. In this context, bootstrapping means financing your venture by yourself. Entrepreneurs often have savings that they are planning to use in the future. These savings often get used at the pre-seed stage of the investment. The second way is through friends and family. Most people take loans from the people closest to them, convincing them about the potential of the success of the business. The loans that come from friends and family are not as dangerous as other ones. Your family members are not that likely to claim a percentage of the business to themselves. They might just want to see you succeed, and they will be happy if you return the money within a reasonable amount of time. There are also some angel investors that are likely to invest in the pre-seed stage, but that is rare. The amount of money to be collected during this stage is arguably somewhere between $200,000 to $500,000. Just because I said that there are two main ways to gather financing in this stage does not mean that these are the only two ways. You can go for angel investors and venture capitals at this stage as well. That is, if your network is strong enough and the idea is firm. But the norm for this stage is bootstrapping and family and friends. After that, you have the seed stage. This is the first official stage of funding for a startup. Before I start talking about that stage, I would like to talk about a fun fact of this stage. The fun fact is, most startups do not grow out of this stage to gather financing for the next rounds, meaning that most startups fail at this stage. And every single good entrepreneurs know about the high failure rates in startups. This stage is very aptly named. This is where your idea starts to take a physical form. You are just starting out by planting the seed. The seed is likely to grow into a big and beautiful tree. After getting the seed funding, companies are most likely to spend it on product development and market research. This stage can also be funded by the founder team along with their friends and family. But there are other ways one can raise capital for a business in this stage. Apart from others, you can get to angel investors for financing. These are people that do not necessarily associate with any venture capitals but do provide financing for various types of businesses. You can also do it through startup incubators, although not that popular and widespread choice, but still a choice. And there are some early stage VCs that can provide funding for a company in the seed stage, but it is still rare for a venture capital to fund a company at this stage. Another way of raising capital in this stage is through crowdfunding. I will explain all of the types of ways you can raise capital in future videos. But for now, you would only get to know about the stages and during which stage a company should go to which way. So in this stage, the extra ways of financing you get is early stage VC incubators, crowdfunding, and angel investing. The approximate amount of money in this stage is somewhat lower than $2 million. And after that, you get to Series A, Series B, and Series C. Sadly, there are no plant or tree stage. These are three different stages of financing, but I am talking about them all together because there are not too many differences between these stages. Obviously, A will come before B and B will come before C. Series A comes after the business has started operating in the market. You already have a version of your product in the market and there are people that are interested in buying it. This would mean that you are somewhat successful in the market and you are also gaining market share. The revenue of your company is either steady or growing. Now it is time for Series A funding. The investors in Series A are not going to be looking at the idea at this point. They are going to focus on how you plan to navigate your business in the market. The strategies are important here. You need to show them the business model you have prepared that will help your business grow and make money. The amount of funding a company can get for Series A would be somewhat between $2 million to $10 million. The main types of investors you are going to get in Series A, B, and C are going to be venture capitals and some rare angel investors. These people are definitely going to want a portion of your business for the investment. And in Series B and C, the companies are absolutely well established. But the reason why companies require funding in each series is different. The company needs to increase its market reach and go for a larger number of customers. The companies might need money to merge with another company or acquire another company. Merger and acquisition likely happens in Series C. There is not too much details to get to know about each of these series. That is why I crammed all of them together in a single section. Now the last stage has to be exit. After a successful run, there will be a time when you need to exit the market. Exit strategies are usually merging with another company or getting acquired by someone else. And the bigger exit strategy is going to be going public. In other words, IPO. The full form of IPO being Initial Public Offering. IPO means that you are going to release the stock of the company to the public. Then your shares will be exchanged in the stock market. Keep in mind that providing your shares in the market does not always mean you are exiting from the company. Sometimes growing companies can issue its share in the market if they feel like they are in the need of financing and going public is a viable option. But going public can be used and often is used by existing owners to sell off the shares they own to the general public to be relieved from the ownership. And initial public offering is not just an easy process to go through. You will definitely need help from underwriting firms or investment banks that are going to help you with determining the value of the share that will be sold, the types of stocks you will be selling, and the numbers of shares you will be selling. More on that later. Fine, I'll do it myself. The harsh reality of the startup climate is that when you are just starting out with only an idea for your business and you have no previous successful startups, it is not very much likely that a lot of investors are going to want to invest in your idea. That is why bootstrapping can be a good idea. It is not an easy concept to pull off, but a lot of startups do it nonetheless. Bootstrapping literally means pulling yourself up by yourself. People use this term outside of business sector as well. It is simply a metaphor for being successful without any help from others. Let's be real for a second here. It is a way of starting your business that is only in the pre-seed stage, nothing else. If your business survives in this stage, you are going to have to need other sources of financing. That is, if your business survives. If you have been following my series of startup investments, you already know that a lot of businesses fail at the pre-seed stage. And after surviving this stage, you have to look for other sources of investment like angel investors, venture capitals, initial public offerings, and everything else. But Bootstrapping is a good way of starting a business. And if you can start it successfully, it will be easier to get future investors. So, bootstrapping means you start your business with the money you have already saved. Let's face it, the money you have saved for bootstrapping is not going to be a lot. You have to make do with whatever you have. But the upside of that can be that you can do whatever you envisioned for your company. No one from the outside is going to try to influence the way you are running the business. And since it is your own money invested in the business, there is a probability that you are going to work hard for your business to succeed. I said there is a probability. That is because there is no outside pressure for your business to perform in a certain way. Another downside can be that whenever you are trying to sell something, people are likely to ask you who is the owner of the company. You have to say that it is you. Let's face it. You are going to be a very successful businessman and everyone around the world will know your name when your startup takes off. But it hasn't taken off yet. So, sadly, not a lot of people know about you yet. So, your namesake is not going to influence a lot of people, be it customers, be it suppliers, or other stakeholders. But if your business was backed by a large venture capital or a huge investor like Peter Thiel, people are going to recognize the investor, and that in turn is going to give your business more credibility. Your friends and family as a potential source of investment for your business. They are the first type of investors for your company. Yes, I have talked about bootstrapping before, but bootstrapping is about doing things by yourself and with your savings. These are the first types of investors that are likely to provide much needed financing for your idea. The reason I said idea is because when you go to them, it is very much likely that you do not have anything solid to show for your business. You just have the idea. These people already know and are likely to trust you to give you the financing. They will not be able to provide a lot of investment for you, but they will give you the initial boost that is going to help you to bring your idea into reality. Try to convince them as you would any other investors. Treat them as the investors you do not personally know. That is because if you are not able to convince these people, there is a high probability that you will not be able to convince others. And they might even ask you that why should they invest in you when your friends and family denied to do so. But it is easier to raise this small amount of capital from them. Keep in mind that just because you know these people does not mean that you should make informal transactions with them. There is a tendency to take loans with a verbal contract that has not been written down anywhere when the lender is a close relative. This can create unnecessary complications later on when you are going to pay back the loan. And as mentioned before, avoid giving any equity in the company. I previously mentioned the money side of this argument, but when you take loan as equity, these lenders become a partner in the company. Now they can voice their opinion in how you run the company. In extreme cases, lenders can interfere with the business process if they are not happy with how you are operating your business. But if they do insist on equity financing, you should go for non-voting stocks. That way, they will not be able to interrupt you in your management process whenever they feel like it. But the better option for friends and family is to go for a regular loan. That way, your lenders are not going to be your business partners. And you can pay back the loan with a reasonable interest amount whenever you are able to. Another thing you should keep in mind when taking loan is to make sure that there are no specific payback periods for the loan. It is better to make the payments with the cash flow of the company. Fixed repayment schedules are going to make you obligated about when you pay back the money. On the other hand, tying in the payment with the cash flow is going to take off the added pressure, and the lender is going to get their payment with full interest as you are making your money from the business. You will decide the percentage of the cash flow that will go to the lenders until they are paid in full. Angel investors. There are many other names for angel investors. They can also be called as business angels, private investors, seed angels, and informal investors. Now, what did they do to deserve this kind of name? Why are they actually called angels? Don't worry, you will get to know about everything about them. First of all, who are the angel investors? Angel investors are people that are likely to invest in your business when it is in the beginning stage. These are wealthy individuals with a lot of money that are likely to help small businesses in their business ventures. Most of the time, these people are actually putting their own money to work so that they can also make a profit in the near future. Now, I have said that angel investors are usually individuals that like to invest into businesses. But nowadays, the definition has morphed a little bit. Angel investors can also be found as groups. A few wealthy individuals can come together who are like-minded, and they are likely to invest in new business ventures that are right up their alley. Meaning, a group of people that are interested in tech are more likely to invest in tech-related startups. These people can either be wealthy individuals that are looking for an investment opportunity, or they can also be successful entrepreneurs who want to help new people in the same sector and give them the initial boost in their business. To be qualified as an angel investor, they have to have some set amount of income and assets. Startups often go for angel investors for the second stage of the business funding. That is the norm. If you don't know about the stages of investment funding, I have made a previous video where I discuss each of the stages of investment process and which type of investors to go for at which stage. Now back to angel investors. Startups usually go for angel investors for the second stage of investment funding, but you can always break any rules at any stage if you are bold enough and connected enough. Getting money from angel investors is a form of equity financing. The angel investors almost always invest for a portion of your company. They might ask for 10% of your company, or they might also ask for 50% of your company. So they are very much likely to ask for some percentage of the company. In most of the cases, these angels are actually careful while investing their money in you. That is because the failure rates in startups are really high. And if you have been following my startup investment series, you already know that. But despite the process being hard, it is definitely better than getting investments through debt financing process. That is, investment through loans. Now, what are the things that the angel investors are going to look for before investing in your startup? Well, Obviously, they're going to look at the business you are proposing to them, but more importantly, they're going to look at the founder. That would be you. They are going to see either you and your founder team are committed to the business or not. They will assess whether you are well suited for running the business or not. They are going to see whether your business plan is clearly thought out or not, whether you have a minimum viable product or not. They will also see if there are people willing to buy your product from you or not. I already said, angel investors are not very likely to invest in the first stage of the investment funding process. They come at the second stage of the investment funding process, and at that stage, your business should have some people lined up to buy from you. They are definitely going to want to see the full market potential of your business. That is, how many people are the potential target market. They will also look at your readiness. That is, whether you are ready to launch your business in the next month, or are you just pitching to them and you will need 18 more months to get ready and start your business. What is ideal for these angel investors is a company that has already started doing its business in the market and people are interested in buying from that company. If a company like that goes in front of angel investors, the investors are likely to jump in to take a share of that business in exchange of their investment. Now, what are the things that you need to keep in mind before closing the deal with angel investor or a group of angel investors? Yes, you should not close the deal with any angel investors just because they are willing to pay you. You need to keep the following things I am going to say in your mind. First of all, when you are making the deal with an angel investor, you have to see beforehand what they are going to provide you for your business that is not money. Yes, money is important, but angel investors can expand your network exponentially. They can help you with their advice if they themselves are entrepreneurs that have experience in the sector you are doing your business in. Also, you should keep in mind that an angel investor can be so much more than just a source of money. A seasoned investor is likely to provide you guidance through the thick and thin of the business world. They can also offer valuable networking opportunities, which is always helpful. And they can also have connections that can help your business improve. Now, let me give an example. For example, an angel investor can have a good connection with a supplier. If the supplier has a good connection with the angel investor and the angel investor is investing in you, the supplier might be willing to provide their raw materials to you at a lower cost than others. That itself can be an unfair advantage for you in the market that will set you apart from your competition. And the lower price you provide to your customer is ultimately going to be your competitive advantage. And if you have been following my other series about strategic management, you know how much businesses love competitive advantage. In short, ask your angels what non-monetary values do they bring to the table apart from the money. You should also try to see beforehand whether the ideas you have about how to run your company clashes with whoever it is you are getting your money from. Since they are going to be a significant partner in the business, they can have a lot of power to direct the way the company operates as a whole. If you have disagreeing interests with your angel investors, you will be at risk of losing the way the company is run at the late stage of the business. And in extreme cases, you can also be kicked out of your own company. And that actually happens in the real world. Another thing is how much this person is going to be involved in your business. I already said that you should look for angel investors that are going to give you a lot more than just money. But you can let go of that depending on your goal. If you do not want the investor to interrupt with your business that much, you can try to look for angels that are less likely to scrutinize every single step of your business. Yes, there are angel investors that are just too rich and want a new investment opportunity. They will not look at how you are conducting your business as long as you are going to be a profitable investment for them. Finding people like these is rare, but it is possible. Then again, it depends on the fact that you can afford to let go of the non-monetary advantages that I have discussed before. You have to weigh in both of the options and set your goal about how you are going to conduct your business in the short term and in the long term. Now I believe I have said almost everything you need to know about angel investors. Let me just mention advantage and disadvantage clearly once again. First of all, getting investment from angel investors is definitely less risky than getting a loan. If the business fails, you do not need to pay back the amount of money you got. I mean, your business is not going to fail, of course. You already know so much about investment from watching my videos, and you will be watching my future videos about the startup investment series. You are not going to fail. But businesses do fail. And if they do, the money the angel investors pay the businesses is going to go down the drain. And that is where the disadvantage comes in. The angel investors also know about the potential of losing this amount of money. So, getting this money from angel investors is not going to be easy at all. And the biggest disadvantage is the one that I have already said in this video over and over again. That is, you are going to lose the full control of your own business. The angel investors can barge in anytime and tell you what to do with your business, your own business. But that is the cost of getting the money from these people. A business incubator is a type of service that helps up-and-coming startups with things that they might need in order to grow as a business. They do not necessarily provide any financing to companies, but they provide the things that you might use your financing on, such as an office space, management training, etc. There can be various different types of incubators. Now, I'd like to talk a little bit about Silicon Valley. I am not going to use any clips from that show because I don't want a copyright strike from HBO. In the series, the house the main characters live in is used as an incubator by the owner, Erlich Bachman. And if any of the members of the house comes up with a business plan while staying there, the owner will get 10% share of the business. That is the main theory behind an incubator. And if you have seen the show, you would also know that the actual incubator there is an example of a really bad incubator if it was to be a real life scenario. In real life, good incubators provide a lot of services other than just a place to live. An incubator can help with enriching the network of the startup owners. They can provide marketing assistance and do parts of the marketing research for them. Incubators can also help with various decision-making processes in the early stage of a business. They can also link you to angel investors and venture capital firms. They can also sometimes help with financial management. Obviously, not everyone can get into an incubator if they want to. they have to prove their worth to the incubators as well. Out of all the people that apply for the admission in an incubation program, only the ones with well thought out business idea and feasible business plans get selected. Previously, I have said that there are different types of incubators, and you can apply for the incubator that can fulfill the need that you currently have to fulfill. Venture capitals are actually companies that invest in all kinds of businesses by gathering money from a group of investors and carefully selecting the companies they are going to invest in from the fund they create from the pooled money. As mentioned in my previous videos on startup investment series, the terms and conditions for raising capitals from a venture capital is not as flexible as the other ones. These venture capitals usually pool investment funds from various sources like pension funds, wealthy individuals, and as well as insurance companies. Then the venture capitals decide where they are going to invest their money in. They are going to analyze the potential of your company in the near future, and based on their financial forecasting, they will decide whether or not to invest in your company. And of course, venture capitals go for equity financing. They are not likely to go for debt financing. The reason venture capitalists are attractive to some businesses is that they have the ability to provide the biggest amount of capital to any business. And of course, since they are promising to provide that much amount of money, there are some obvious catches. First of all, you will not be able to choose the direction your own company is going. VC firms are going to own enough shares of the company to have a say in whatever managerial decisions you are planning to take. So, going with a venture capital firm is not going to be a good idea if you want to direct the way your business is going to go by yourself. Another thing you need to be clear about is that venture capital firms do not necessarily invest on startups and early stage business ideas. They find out the businesses that are already successful, and they will value the company themselves to find out the potential earnings they can get by investing in there. These people will only invest in businesses if they are sure about the positive returns they are going to get. You are likely to get one or two business books and even blogs that are going to say that venture capital firms are there to help out with the seed stage funding and nurturing the ideas of up-and-coming entrepreneurs. But the reality is, they are likely to fund the businesses that have already proven to have a successful business model and are thinking about reaching a larger portion of the market. Even at that point, it is risky for the venture capitalists to invest. And the reality is that they often invest in only 1% of the businesses that approach them for the funding. That is why the pitch in front of these people should be prepared more meticulously than anything else. And the last video from this series of mine is going to be about how to pitch your idea. You bet I'll make the best video explaining everything you need to know about pitching your business idea to anyone, absolutely anybody. There are some obvious benefits of getting the funding from a venture capital firm. The first one would be that you will get help from them in various managerial processes. You can compare this point to a similar thing mentioned for angel investors. But the help in here is going to be multiple times greater than that of the angels. That's because there are a lot of experienced businessmen that are likely to be involved in a well-known venture capital firm. They can help you out with a lot of things as well as provide with valuable network that you can use at any section of the business. Since VC firms provide equity financing, they usually have one or more person present in the board of directors. I explained a similar point as a disadvantage in a situation where you will not be able to do whatever you want to do with your company. The overall direction of the company will be decided by everyone present at the board, which will include the members from the venture capital firm as well. But it can be a good thing, especially when you actually lack the experience and expertise for deciding on major managerial decisions. Most of us believe that we will be able to run a business by ourselves with the help of a small number of people. Keep in mind, it is more or less possible to launch and steer a business in the beginning years. But as the business grows, it will soon be overwhelming for a small group of people to do everything that is needed for the betterment of the company. You simply cannot know everything there is to know about running a business. That is why the help from venture capital firms can be an uplifting boost for companies. Everything has its positive and negative sides. So before going into venture capital firms, you need to weigh in both the pros and the cons and then go for them. I will talk about initial public offering in the sense of startup investments. In this video, I will try to give out all the basic information you need to know about initial public offering. So, it is initial public offering. You are offering something to the public for the first time. This is the process a private company needs to go through in order to become a public one. The company will start selling its shares in the stock market for the first time. There are two main reasons why a company goes public. First of all, they might need money. They will be able to raise their capital by selling their shares in the stock market. There are a lot of reasons behind why a company can need capital. I think I have talked about the reasons a lot in this series. They might want to expand their business to another country, etc. The second reason is exiting the business. A partner in the company might decide that they will sell off the shares they have in the general market. Now, IPO is the first time the company will offer its share to the public. Before that, the company will be owned by a limited number of partners who have founded or invested in them. But after IPO, anyone can buy a share in the company. You need to keep in mind that you only get money when you sell the shares you own for the first time. Then it is owned by whoever bought it from the stock market. They can resell it whenever they want. Even if they resell it for double the price they bought it in, you, the company owner, are not going to make any money from that transaction. You will earn money only for the first time you sell the shares. There is an option for the company to buy back shares from the stock market as well. And there can be a number of reasons why a company can decide to buy their shares back from the market. But for now, let us get to know the process of initial public offering a little bit. First of all, you need to define the exact reason why you are taking this decision. If your company requires capital, clearly state that for what reason you need the capital. There can be 1,000 of reasons why financing is required. You need to state that. Then you have to hire an investment bank as underwriters. There are other things the investment banks do, but underwriting is a big part of it. You also need to choose the investment bank very carefully. That is because a good investment bank is going to do almost everything needed for the IPO, and they will also make sure that you get the best outcome from going public. The investment bank is going to do the final valuation of the company before going public. They are going to decide the number of stocks that are going to be sold in the market. And they will also decide the price of each individual share. They have additional responsibilities that include the marketing of the shares before it goes public. Then you also need to decide about the stock markets that you will be selling the stocks in. This is also an important decision to make, as there are a lot of markets a stock can be exchanged. After all of that, the share is going to be released to the market in a set date, and people will start trading the stocks with each other. There are some obvious advantages and disadvantages of IPO. The biggest risk with IPO is that you might not be able to raise the amount of money needed. There is a chance that you go through all of the process needed for the initial public offering and you do not get the money you needed in the first place. You might have needed $20 million for expanding your business into a new area, but you might only end up with $10 million from the IPO. If that happens, the whole process of the initial public offering is going to be a failure. After that, you also have to pay a heavy fee to the investment banks for performing all of the services required to go public. Investment banks can be very good, but they are also very costly. Another negative outcome after going public is that all of the information regarding your company is going to be available to the general public. Most of the actions taken by you for your company is going to be under public scrutiny. As a founder, you might have a long-term plan for your company. As you have taken all these steps to carry your business forward in the market, you definitely have an idea about what you want to achieve with the company. You might want to leave a bigger mark in the industry. You might want to help as many people as possible with your endeavor. But once your stocks are being traded in the market, there is always going to be a pressure on you to maximize the profit in the next quarter. With the short-term mindset, you are never going to be able to achieve the long-term goal of your business. The constant pressure of making a profit in the short run is always going to be on you, and you cannot really escape that. You might think you can, but you cannot. You yourself might be willing to take a financial hit for the next 1 or 2 years for a long-term goal. But not everyone is going to understand that. And there is another problem here that you need to consider. You might feel like being a rebel against the majority. After all, it is your own company. You might still strive for the long-term vision you have had for the company. The possibility of you getting voted out of your own company is going to be high in that case. And there are some famous examples here as well. And of course, there is a potential of losing the overall control of your company, since the shares of your company is going to be owned by others. Typically, companies do not sell a lot of shares that will give the shareholders the majority rights. Although there is a way to revoke the voting rights of the shareholders if you sell preferred stocks instead of common stocks. But with preferred stocks, you have to provide a predetermined steady dividend. There are 9 components of the business model canvas. These are the components. Some might look familiar, some might not. Sit back and relax. I will explain all of them one by one, and there will be multiple examples for each of them. What is a business model canvas in the first place? It is your entire business model in a canvas. Business model is about describing how the company does business. In this one single page, you will have all of the information related to your business model that first year business students learn to write an entire paper on. I don't know about you, but in my first or second semester, we had a big project on the business model of a hypothetical business. We had to write an entire paper on that. And then a few semesters later, we learned that we don't need to write down the details all that much. And there is already a tool that is much better to visualize all of the components, and it is very easy for investors to understand. The investors don't have a lot of time, and they can just look at the business model canvas and understand what your business is all about. The business model canvas was first proposed by Alexander Osterwalder. Now you can group some of these building blocks together. And the canvas is designed accordingly. Of course it is. This section is called the offering section. This one is about infrastructure. And this section is all about your customers. And the last section is about money. Everything related to money, as in finances. Now let's start. We will start with value proposition first. Value proposition is exactly what you are doing with your business. What are you going to do? Meaning, what is the product or service you are providing to your prospective customers? In other words, what value you are proposing in the market? What is the value you are adding to the people? So in this section, you need to write exactly what problem that the customers have that your business aims to solve. What is it that you are providing to the people? This is actually what you are selling. You have to properly illustrate that in this section. Alright, now let's move on with the customer side. There are 3 building blocks over here. Customer segments, customer relationship, and channels. First, let's talk about customer segment. Who is it you are selling to? Customer segment is actually your customer. You are not creating your product for every single person in the entire market. There are specific types of people that you have to target and focus on selling your goods or services to them. There are companies that go for the entire market, that is mass market strategy. But if you are going to target the entire market, you have to write down in this section that you are doing that. You can go for niche. You can go for 2 or 3 different segments with 2 or 3 different variations of the product or service you are providing. In this specific section, you will write down who are your customers, who you will be selling to. Next, let's talk about customer relationships. In this section, you are going to write down how involved you are going to be with your customers, how you are going to get new customers, and how you are going to keep them with you. That is, make sure they don't go for another business. You can just sell your product and bounce. No need for customer relationship. You can provide additional services and increase that positive customer relationship. Businesses also provide dedicated personal assistants. For service providers, you have to have a good relationship with the customers if you want your customers to make a second purchase. But if you are selling toilet papers, you don't really need that. Now, let's talk about channels. Channel is how you are actually delivering your product or service to the customers. There are many ways you can provide your value proposition to the customers. Often, companies use multiple channels. Choosing a channel is very important for people. Because if you only sell your goods on brick and mortar shops and most of your customer segment are actually very busy and prefer online delivery, it will be a fatal mistake for your business to not open an online shop. Channel is how customers get your product or service. Now we will move on to the infrastructure side. Here we have key partners, key activities, and key resources. Key. Let's talk about key partners first. Key partners are the people that are not part of the organization, not part of your organization that you really need to function as a business properly. The most common key partners are usually the suppliers of your products, the people you get the raw materials from for your product. There are strategic alliances where another company can be a key partner. Complementary businesses can become key partners in the market as well. Complementary businesses meaning if you are a tire manufacturer, you can try to make a strategic alliance with a car manufacturer, and that would be a key partner for you. Next, we will talk about key activities. What do you actually need to do to make the business happen? If you are producing a good, how are you doing that? Talk a little bit about the supply chain. If you are a service provider, how are you going to provide your service to the prospective customers? Those are your key activities. What do you need to do in order to provide your value proposition to the customer segments? Then we have key resources. What do you actually need to provide the value proposition to the customers? These can be the raw materials for producing your goods. These can be the people working in your company. It can be the factory or the warehouse or the actual place where you are selling your service to the people. Oh wait, excuse me, not selling your service, providing your service. Now let's move on with the finances section. There are two building blocks in here. Let's talk about cost structure first. How much money do you need to spend in your business? Where the money is going? Is it going more towards the key resources or the key activities? How much money do you need? If you are producing goods, can you go for economies of scale or economies of scope? What are your fixed costs that you have to pay every month? And what are the variable costs that depend on other things? Then, the last section is revenue streams. Of course, you need revenue streams. How are the customers paying? Are they paying after buying the product once? Are they paying a subscription fee? Do you provide the freemium model where they get some of your service for free and for premium content they have to pay more? You have to write down how you are going to make money. For the sake of business model canvas, just remember that you have to write down how much you will charge from each customers and how you will charge them. That's it. Let's move on with examples. This is the model. These are the building blocks of the business model canvas. Let's make smartphones. Our value proposition would be smartphones. But here's the catch. We are making smartphones for people aged over 60. These smartphones will be sturdier, they will have more battery power, and of course user-friendly. They will have only the basic options like calling, video chat, maps, and the channel would be both online and offline. And since you are targeting older people, you definitely need to have proper after-sales service. That will increase your positive brand value. The key partners can be your manufacturers. You will be partners with a company that will manufacture everything that is to your smartphone. And what you will do, that is key activities, is you are going to assemble the smartphone. Assembly. Someone else is making that, manufacturing that. They will be your key partners. Very important. What you will do is you are going to assemble that. For assembling, you will need factories and people that work in there. They will be your key resources. Another key resource can be your brand patent, so that nobody can copy your business model. You will be the only one that will be selling these simplified versions of smartphones to older people. There will be many examples in this cost structure. Some are payments to the manufacturers, of course, utility bills, all types of utility bills, and salaries to your employees. And your main revenue stream will be asset sales. You can charge for after sales service after a small amount of time, but for the first 6 months to 1 year, you probably need to provide free after sales service if any issue arises. Main revenue stream will be asset sales, meaning when you're selling your smartphones, you will get the money. That was my first example. Now, the second example is a little bit weird, not as conventional as the first one. But hear me out. It can be profitable, alright? What you are going to have is you are going to sell pictures of a van, of your custom made van in your website. Alright? There will be pictures on your website. People have to pay to see these photos. It will be your own custom made van, and the pictures will be only available in this single website alone, nowhere else on the internet. And the customer segments can be men aged over 30. I think they will be the people that will be willing to pay money to see pictures of your van. I don't know, women might want to see that, but main customer segment will be men aged over 30. Just because you have one customer segment in your mind while designing your value proposition does not mean no one else can buy from you. Alright? Other customer segments can buy from you, but you are designing your value proposition for this specific customer segment. The channel obviously will be an exclusive website. How are you going to build customer relationships? You can have one-on-one communication with people paying to see the pictures. Your key partners are obviously going to be the web host, the company that is hosting your website, key activities, I don't know, taking pictures of your van, and the maintenance of the van can also be part of your key activities. Key resources will be the van, of course, the camera, and you need to put a copyright on these pictures so that it does not go around the internet and devalue your pictures. They will be able to find these pictures only on your website. The cost structure would be your web hosting fee. There will be also the recording gear cost and van maintenance cost. The revenue stream would be subscription fee. These people that are willing to pay you to see the pictures of your van need to give you money every month, maybe $5, maybe $10, maybe there will be different tiers for different types of pictures, maybe a higher tier for interior pictures of the van. I don't know. You can get creative with that. I hope that was enough for everyone. Here I will talk about how to pitch your business in front of investors. All kinds of investors. Different people have different ideas on a pitch. Some would think you need to prepare your materials, make a slideshow, and present in front of a group of people. Some would think you will need to talk to people everywhere you can that might have a slight chance of providing some funds for your business. Some other person would think that you need to talk to your friends and family that have some money to spare. And all of you would be right in one way or another. And I'm going to talk about all of that right now. First, how long your pitch should be. And it is a trick question. You should prepare multiple pitches for different situations. I am going to talk about 3 different right now. The first one would be 60 seconds or less. Yes, you need to communicate your entire business plan in less than 60 seconds. How do you do that? Tell the potential investor the problem you're solving in the market. That is what your business will be doing after all, solving a specific problem in the market. You need to make them understand that there are people that have this specific problem and you have a good way of solving that specific problem. Alright, then you should prepare a 5-minute pitch. You are going to present this in front of people that are likely to listen to you but do not have a lot of time in their hand. In this pitch, you should include what you do, what is your target market, who are your competitors, and shortly mention the marketing plan and what is your forecasted plan after 1 year. Then you should prepare a 15-minute long pitch. These are for the people that have already agreed to listen to what you have to sell. It depends on you that whether they are going to invest on your venture or not. You need to understand that the 15-minute one is going to be your biggest and longest pitch. Make sure to include everything an investor might be interested to know. Firstly, you should present the problem in the market that no one is solving or not solving in an efficient or unique manner. Then you get to the solution you are going to provide. Arranging your pitch to flow like a story is always a plus. Then you should provide an industry analysis. This should include the overall environment of the business. The marketing strategy and the business model comes next. Tell them how you are planning to take your product or service in front of the customers. Then you need to tell them how you are going to get money from the customers. There are a lot of ways to do that as well. Also tell them about the risks for going out with the plan. And most importantly, you have to tell them what all of your flamboyant plan is going to cost. After all, you are planning to get money from the investors. You also need to show the projected return on investment. Return on investment is the money they are going to get back after investing in your company. And of course, a solid forecasting plan is needed for that. Contents of the pitch. I just talked about what you need to have in the pitch. Now, just a little details about each of them. First of all, designing your pitch as a story can be a good idea to explain what your product or service you are selling to the people. People have problems they need solving, and if you tell it like a story and your audience can understand or even relate to what you are selling to them, the probability of you getting your investment is going to get higher. But make sure you do not get carried away with your story. You need to stay focused through the entire pitch. Of course, you need to practice it first. If you are selling tangible goods, it is a good idea to have a working prototype that you can demonstrate in front of them. You also need to explain what makes you different from your existing competitors and future competitors. Why are people going to buy from you and not from your competitors? This differentiating factor is going to help you beat the market. You have to then explain clearly who exactly is going to buy from you and are there enough people there like that. If you can identify that you are going to sell chairs for left-handed people, you also need to know that if there are enough left-handed people that actually want your product so you can make a profit. You need to explain their demographic and psychographic features. Then you need to explain your marketing strategy. How are you going to get in front of your potential customers? No matter how good your product is, if customers don't even know about the product, then you're not going to be able to sell your product to them. You also need to talk about the revenue model. In front of seasoned investors, you just need to mention the name of the revenue model. And in front of the people that don't really know that much about these revenue models, you need to explain a little more. You also need to tell them how long is it going to take for them to make their money back. How soon can they expect their money back? And when are they going to start making profit on it? And lastly, well, I already said it, but again, you also need to tell them exactly how much money you are going to need from them. It is kind of important. You also need to know about the people you are going to pitch in front of. Who exactly are you talking to? What are their interests in? I mean, if your startup is about a health product, going to a venture capital firm that is primarily interested in tech is not going to be the best idea. You can still go there and try it out if they agree to listen to you. There is no hard and fast rule like that, but going to people that are likely to invest in what you are making is a better idea. The words you choose to speak in front of these people are also going to be really important. There will be investors that will be interested in the money. You need to focus on that sector to them. Tell them how big your target market is. Tell them how profitable your business can be. Make them understand how soon you are likely to start making a profit. Then there are going to be people that are not going to be that much interested in making their money back. They might be interested in helping people. Tell them how your product or service is going to help out everyone around the entire world. How you are going to increase the quality of life of everyone using your product. The main business idea might be the same, but what you say in front of these people should be tailored in a way that is likely to give them a little nudge towards investing more to you. There can be various tools that is going to be helpful in your pitch. You can prepare a slideshow that will help visualize what you are saying to the investors. You can have them printed out as well. For making the slide, you need to make sure they are neither too boring nor too flashy. You need to strike a balance between the both of them. You can have the printed out business plan and marketing plan with you as well. And if your product is a tangible good, you can have a minimum viable product in front of the investors. These are the prototypes that will help visualize exactly what you are making and how they will be helping the customers. I have some other things I want to talk about that I could not put in a specific group, so I will call this section additional tips. If you have some people on your management team that have accomplished something before, tell that first. Tell your investors that this specific person on your team has worked on a particular startup before and sold that business for a specific amount of money, and now they are working with you in whatever you are doing. You yourself can have some prior accomplishments of your own, and you can use that to sell your business. But it is a little bit unlikely that you already have a successful startup launched and you are watching this video to learn how to pitch your business in front of investors. Comment below if you are doing that. Remember, the investors are not only investing in your business, they are also investing in you, the people that will be working to make this business a success. The last point. When you're talking, try to sound enthusiastic and energetic. It shows that you are excited for this business. You are eager to get this business up and running. If you speak in a monotone voice, it indirectly conveys the message that even you are not that excited on the idea that you are proposing. Why are they going to give you their hard-earned money when they don't even trust you to work hard on the business? This is it. This is all I'm going to talk about this topic. Thank you so much for sticking around. I am really grateful for each and every one of you. And I am thankful for that. And I also have to say, if you are not subscribed, you can do that if you thought this video was helpful in any way. You can also like this video to let me know directly that you liked the video. You can share this video with anyone else who you think might find the contents provided in this video to be helpful. And if you want to directly support me in the growth of this channel, you can go to Patreon and help me out over there. Now, a little bonus section. You might know about the term elevator pitch. But did you know why this type of pitch is called an elevator pitch? The origin of the term, I don't really know. I am not sure which one is the correct one. You can find multiple origin stories of this term if you go to search it on the internet. How's that for a bonus fact? I don't really know. For a long time, I thought this term originated because students in a certain place used to pitch their business ideas to their professors in the elevators of that place. That is why it was called elevator pitch. But a couple of years ago, I tried to find out if that is the correct one on the internet. And I found out that there are a lot of origin stories of the term elevator pitch. Some say people pitched their movie ideas to Hollywood producers in elevators. Some say the first pitch for the literal elevator was short and to the point. That is why it is called elevator pitch. But I don't really know. That is my short answer. One of my professors actually told me about the first origin story of the elevator pitch I just talked about. That is why I did not question it for a long time and was surprised to see that there are a lot of stories like that. Well, if you know why elevator pitch is called elevator pitch, you can comment below. This is the official end of this video. Thank you so much for watching, if you are still watching. And lastly, I really hope you have learned something new today. Goodbye for now.